should you sell your investment properties in 2026? Right now, there's a lot of uncertainty in the market and buyers don't really know what to do. Sellers aren't really sure what to do. And if you have some investment property in Chattanooga and you're thinking about selling those properties right now, you might be thinking, well, should you go ahead and sell right now or should you wait? So today I have my good friend Jeff Holst, and he's going to talk to us about that. And Jeff is a real estate investor and author. He's a speaker, and he also is the co-founder of the Last Life Ever podcast and mastermind. So Jeff, what do you see going on in the Chattanooga real estate market right now?
Well, I mean, I think unless you're not paying attention, if people are listening to your show, they probably already know the inventory is super high.
It is.
It's what I think you said a 6-year high. I'm using your
Actually,
numbers.
10-year high.
10-year
Yeah,
high. All
almost
right.
11-year high now.
Okay. Well, that's pretty high. I will say that. How many units are we talking about? Like, is it like 6,000 or something then?
It's so the active listings right now, it's a little over 4,000. Just went over 4,000 over the past couple of weeks or so. Yeah.
Yeah. All right. That makes sense because you said like 10, 11 year high.
Yep.
So that puts us like 2016 ish.
Yep.
That makes sense because it was a lot higher. Like, because I remember back in 2016. So I've been investing in Chattanooga since around 2016, honestly. Back in 2016, inventory was around that level, and it actually might have been coming down. It was probably like 3,900 at that point. So that's why you're saying like close to an 11-year high.
Yeah.
And we were saying like, man, inventory is historically high.
I remember that. Yes.
Like, but it's trending in the right direction. I think the issue now is it's trending in the wrong direction. So the question is, how long is it going to do that? You know, when inventory is going up, that's a pretty good sign that, you know, we're in a buyer's market and not a seller's market. So, you know, you started off with like, should you sell now? I mean, I don't know, maybe.
Yeah.
I mean, if you get the right price,
Yeah.
but you do have to be thinking about, you know, where interest rates are, because this could turn really fast. That's the one thing. Like, a lot of the extra inventory is a function of people not selling for several years because interest rates are higher.
Yeah.
And eventually that backlog in potential sales just people give up on waiting for interest rates and they're like, I gotta sell. Like I already moved like 3 years ago. I can't keep my house anymore, or whatever it is.
Exactly.
And so a lot of the new inventory is that. And then also this time of the year is always a higher inventory period as well. So some of that is just, hey, you know, it's spring and summer. People like to sell in the spring and summer. So but I mean, that doesn't justify, you know, 10-year high, obviously, but some of it is that, and it will. I think the danger people have when they're trying to predict where we are in the market here in Chattanooga or really nationally is inventory may go down in the fall, but that doesn't prove that the trend's turned around because inventory often goes down in the fall. Although if it goes up in the fall, that might be a sign that the trend is accelerating.
It could, definitely. And that's what I want to look at too, is what's going to happen by the end of the year. I think you're right. Like if it keeps on going up, we may be looking at even more of a stronger buyer's market by the end of the year.
Yeah, it's definitely possible. I think that the biggest indication of whether it's going to be a buyer's market or not is going to be whether interest rates stay the same, go up or go down. If interest rates go up, that's going to cause sales to stagnate even more.
Yeah, exactly.
If they stay the same, I don't think it's going to have that much of an impact because we're adjusted to the new norm. And you know, I know a lot of real estate people that say, you know, interest rates are the problem. No, interest rates aren't the problem. It's the change in interest rates that's the problem. The rates that we're paying now, 6.5%, 7%, pretty historically normal, actually.
Yeah.
Like if you look back over like a 50-year period, the average rate is like 6.5%. The problem is we saw these ridiculously low rates, 2% and 3% rates for a couple of years. And then after COVID, we saw another drop in rates. And so a lot of people have really low interest rates, which is fine, but low interest rates tend to create stagnation in the market because people have a low interest rate are like, I can't sell, I can't refinance. It ties up liquidity, and it slows the market down. Which actually might be a good thing in the long run because we do need to go through market cycles. But in the short run, it's kind of painful if you're trying to sell right now.
Yeah, because a lot of sellers, they'd have to, if they sold their house right now, they'd have to basically downsize instead of getting a better house. They'd have to get like a smaller house or something less expensive just to be able to make up for the difference in the interest rate if they already have a lower rate right now.
Yeah, I mean, unless they have a lot of equity or something, so they can put a huge amount down. Because, I mean, the one advantage is like if you have a 3% rate, it's not a brand new mortgage. There's a good chance it's an 8-year-old mortgage. Now, I mean, there are some that are 4 years old that are 3.5%, 4%. But if there's a good chance it's 7 or 8 years old, and the values have gone up during that time, So you probably have some equity. You've also paid your mortgage down some during that time, more likely than not. Let's say you had a 30-year mortgage at 4%. After 7 years, you probably paid off a quarter of your balance.
Yeah.
So you had a $400,000 house. Now you owe $300,000 and it's worth $500,000. That kind of $200,000 put down on a house, even if you have to buy a $600,000 house, and then re-amortized over 30 years, even with the interest rate jump, might not be as painful as people think.
Makes sense.
And the problem is people are like, oh, I'm not going to pay 6%. I have a 4% mortgage now.
Yeah.
And I think sometimes that's really short-sighted. I see investors do that which is even crazier to me, because like I get it with a homeowner just like getting fixated on interest rates because you don't spend a lot of time on it. But like investors should be like looking at their return on equity.
They get a good deal.
Like,
they have good cash flow. Yeah, exactly.
I mean, it doesn't really matter what you pay if it
Yeah.
covers itself. And the other thing is like, one of my friends is like keen to say like, you know, you marry the asset, but you date the debt, right? Like you can change the debt later. Like if interest rates go down, you just refinance. You pay 6% now and they go back to 4 for some reason, which seems unlikely, but if they do, that's fine. I'm going to refinance everything.
Yeah. And I say for investors right now, the big thing is just the cost of most investment properties. Because if you look at a lot of the multifamily stuff on the MLS, most of it at the price it's out right now doesn't even cash flow. And that's why a lot of it has been sitting there for months and months. So that really, I think, is the issue is just, yes, investors can make it work with a higher interest rate, but they got to get a better deal, which isn't, you're not really seeing a whole lot of that right now, unfortunately.
Yeah. I mean, the only thing that really makes sense on the multifamily, like on the MLS, is that like 1 to 4 unit stuff where like if someone's going to move in and they're going to get homeowner financing, 30-year terms, better interest rates than I'm going to get. And also they don't mind not cash flowing. You know, if you're going to buy a duplex and live in one side and collect $1,200 in rent and have a $1,700 payment, it's not that big of a deal because now you're effectively lowering your rent cost. Even if you had a $2,000 payment, you know, it really doesn't matter that much if you can afford it and you want to live there. And eventually the rents will go up and eventually you'll have an opportunity to potentially refinance and potentially move out and rent in the other unit and stuff. And so, you know, you can make these things work. You just can't make them work very well as an investor unless you put a lot of money down.
What would you say to investors that maybe they bought a multifamily property within the past 10 to 15 years, they got a really low interest rate or a good interest rate, but now they have to refinance that commercial loan and they've got a much higher interest rate. Maybe they don't really have much cash flow, if any. So what do you think they should do in that scenario?
Well, if they don't have a choice but to refinance or sell, right?
Yeah, exactly.
You know, if they have a balloon, you know, a lot of the stuff we did a few years ago, we did with ARMs because we were like, well, worst case scenario, they'll adjust the rate and we'll still have the debt on it because the big risk is, and I always say it's easy to time the market. It's like buy whenever you buy. If the asset makes sense when you buy it, it's fine. But and then you just sell it when it's high, right? But the trick is, that only works if you have adequate cash flow, you have adequate cash reserves in case something happens, and you have long-term debt. Because if you don't have long-term debt in place, you don't want, you know, you end up in a situation where you have to sell or refinance in a recession. I don't think we're in a recession necessarily now, but we could be in a year. Now we might turn around and be fine. I mean, there's a lot of leading indicators that show recessionary signs, but there's a whole bunch that show like massive amounts of growth too. AI is kind of throwing a wrench in that. Like we don't know where the economy is going, but I do know that if more net wealth is produced, then the economy will grow.
What do you think just about interest rates though? Because we talked about that quite a bit. So like, do you, and it depends on like who you listen to. Some people think it'll go up, some people think it'll go down, but like what's your impression on interest rates? Let's say just till the end of the year. Is anything going to change?
I think it'll be pretty similar at the end of the year than it is now. I could be wrong, but inflation has been sticky and persistent, like, you know, and it bounced back up. A lot of that's because of the recent war and the oil price increases and the energy price increases, which it's not just about the price of oil. It's also about the price of moving paper towels from California to Florida, right? They got to get on a truck and that costs more money when oil is more expensive. And it's also about building making the plastic that's a petroleum product that goes around the paper towel. So like, you know, everything goes up when energy prices go up. And so that does cause like transient inflation. So the question is that temporary or is it more permanent? And we don't really know right now. It's too close to the situation. Inflation tends to cause rates to, it tends to cause rates to go up because that's inflation, which people think of as bad, is actually a sign that the economy is doing really well. There's a lot of growth in the economy, so things are getting more expensive. It can cause problems, of course, if it gets out of hand because wages might not be going up as fast as prices and all that kind of stuff. But in general, the economic theory is if the economy is getting overheated, we have inflation. And when it's overheated, we need to raise rates to slow the economy down.
Right.
A lot of times when we do that, that causes a recession. Because if rates go up really fast, then people stop buying stuff. Now, the weird part from the housing market is people aren't buying stuff anyway. And but we haven't moved into a recession. Like rates went up pretty fast. And we just kind of been chilling at this like sort of stagnated housing market.
I think that's why people are just kind of confused about what to do right now. It's because of that. It's like, I mean, you hear a lot of different opinions and it's like, people just really don't know what direction things are going to go.
Yeah. And I mean, I don't either. Like, and that's my point. Like the inflation tends to make me think they'll raise rates. On the other hand, we have a new Federal Reserve chair who doesn't want to raise rates. We have a president who doesn't want rates to go up. And there's a lot of economic indicators that are shocking. Like just this week, or maybe last week now, because it's Tuesday today, there was a stat that came out that said that like that net economic growth came out like 50% higher than they projected for April.
That's
and
interesting.
It's like insane. I don't remember the exact number, but it was like a lot. And that tends to be inflationary when there's a lot of growth. The thing is, though, because the market's been so stagnant, if people start making more money because there's a lot of growth, like real wealth is produced, the inflation becomes less of an issue. And interest rates become less of an issue because
people make more money.
Exactly. It will drive the values up, and people
definitely.
have more money to spend. And the thing is, like, it's easy to say you don't want to refinance your 2% loan because you bought a $200,000 house 30 years ago at 2% or something stupid like that, whatever it is, right? That's cool. But if that house is now worth $20 million, the loan is inconsequential. You sell the house or you, and yes, it might take longer to sell it because it's more, it's a more expensive house and you have to borrow more money and all that. But I mean, you just do it anyway. You figure it out. And it's the same with refinancing. If you get enough equity, especially as an investor, you really need to either sell or refinance every 3 to 5 years. Because you're trapping equity. A lot of times we have 20-year loans, and 5 years in, I've paid off 19% of the loan, and the value went up because we raised the rents and all that kind of stuff. Now you're sitting on 30, 40% more equity than you had before. Well, if you put 20% down, now you have 50% equity.
Yep.
That at that point, if you're not selling or refinancing, you're leaving a bunch of money trapped and you're not getting a great return on it anymore. Because ironically, returns on equity go down the more equity you have. Right?
So you really kind of answered the question about the investors that had a lower interest rate and now it's higher. Yeah. Really, you're saying you should just sell or refinance within 3 to 5 years typically anyway. I mean, in a lot of cases.
Yeah, I mean, obviously there's exceptions. If you're in a down market and you have long-term debt, you might want to wait it out. But you should be making this, like if you're not evaluating your equity and specifically your return on equity every year, you're making a big mistake. And just, for simplicity, the way that you would do this is you just take what you think you would get if you sold the property after sales cost. Say, let's just make the numbers really easy. You have $1 million property and you owe $600,000 on it, and you believe after you sell it, you're going to get $900,000 because you're going to have sales commissions and whatever. That's cool. So that means that $900,000 minus the $600,000 is $300,000. Well, if you're making $40,000 a year cash flow on it, you just do 40,000 divided by 300,000. You come up with a number, which I should have done something that was a lot easier than 4 divided by 3. But it's like 1 point. So I guess it's like 33% on your money or something. Well, if you're making 33% on your equity, it's fine. But if you're making like, $3,000 a year on 300,000, so you're making 1% on your equity, you got to sell it or you got to refinance it because you're not. I mean, you're way better off to just sell it and buy something else at that point, right? Like take your $300,000 that you're going to have after all your costs and go buy something else. If you're worried about taxes, do a 1031 or do a cost segregation on the new asset. There's ways to avoid the tax consequences of selling, and just, go buy something that makes 10%. So now instead of making $3,000, you're making $30,000 a year.
Yeah. Yeah, and that really also answers the question about just what should investors do right now if they're looking to sell. I mean, that pretty much explains it. You got to kind of just evaluate the situation and make a decision based on like what you're going to get out of it. What's your return going to be? What could you potentially get in terms of recapturing equity if you sold it? So it really kind of comes down to those.
Yeah, and what are you going to do with it too, and what are you going to reinvest it at?
Yeah.
I sold a couple of duplexes last year. One this year, one last year. I had a bunch of equity in them because I had credit card debt that I needed to liquidate. And I'm like, I don't need to reinvest this to get a better return than my investment equity. I'm getting an 8% return on equity, not bad, right? Yeah. But my credit card interest is 20%. So if I pay off the credit cards, I'm making 20%. So I'm getting 12% more effective cash because money is very fungible. Fungible is, for people that don't know, is just a word that means money in one hand is the same as money in the other hand. You can shift it around. It doesn't matter. So if you save $1, that's like the Ben Franklin thing, right? A penny saved is a penny earned. I always thought that was weird because like saving a penny doesn't feel like earning a penny, but it actually is because you have an extra penny. It doesn't matter if you earned it somewhere else. That penny saved is what saved you from spending that earning. So,
yeah. Well, now we don't have pennies anymore, but just
a dollar saved is a dollar earned.
Dime, whatever.
100,000 saved is 100,000 earned. It doesn't really matter. But the point is, like when I had $80,000 in credit card debt, and at 20%, saving 12% on that is $10,000 a year. And I'm $10,000 a year richer by selling my duplex. Because I'm saving 12%, or whatever.
And I think also the inflation we've seen, especially over the past 5, 6, 7 years. I mean, there's the COVID bubble basically. I mean, values went up. They were going up about 12% a year for a few years in Chattanooga. So really, if someone wants to capture that equity, that really is a good time. Especially kind of right now, where we're kind of at the tip of what looks like it's the tip of the market cycle, and things have started to flatline. There's more price cuts and things like that. If you can sell your rental property right now, you can, and if you've bought it within the past 4, 5, 6 years, you can really recapture some equity. So I think that makes sense for people that want to sell and just gain the equity that they have.
Yeah, I mean, you just got to evaluate the situation. If you bought something last year, you're probably not. It's not.
Right, exactly.
It's not a good time to sell. But if you bought something 20 years ago, if you're
definitely,
you haven't refinanced it and you bought it 20 years ago, you should be refinancing or selling. It's one or the other. And I think it is a good point to sell because there's at least enough uncertainty in the market that that stuff could go down in value. Like, it didn't, like during the Great Recession, stuff didn't go down that much in Chattanooga because we've had consistent, steady growth here. But before the Great Recession, and this is a big but actually, prices didn't go up like they did everywhere else in the world. I'm from Grand Rapids, and in Grand Rapids, Michigan, houses in 2005, 2006 were going up 15, 20% a year.
Yeah.
And, in Chattanooga, they were going up 3% a year during that same time. So one reason they didn't crash in 2010 like they did in Grand Rapids is they hadn't gotten overinflated to the same extent. Now, you just said it, like things have been going up 10, 12% a year.
Yes.
So that doesn't necessarily mean that it's wrong because, what happens is over the long term, housing prices, they always regress to the mean inflation. So if inflation is 10%, houses should go up 10%. No, they might go up 15% one year and up, 6% the next year and up 4% the next year and up 12 the next year, but they should average at 10%, right? When you average it out over the long term. And there's been a couple of long term, like 200-year studies that prove that that's true. And it makes sense intuitively because labor prices go up at the rate of inflation, material prices go up at the rate of inflation, land is going to go up at the rate of inflation. So as a result of that, over the very long period of time, it matches the rate of inflation. And that's going to be true in Chattanooga. It's going to be true in Grand Rapids. What happened in 2006 is stuff in Grand Rapids went up faster than inflation. Yeah. And then they crashed back to that mean inflationary line. In Chattanooga, it went up less than inflation, so it didn't need to crash during the crash. So the real question now is the market inflated or not? And I don't know the answer to that. It feels toppy, but it's about toppy for like 3 years. It's not like, it's not like, and that doesn't prove that it's inflated. It might mean that it might mean that houses went up too fast. And I would actually argue that the inflation of housing prices occurred post-COVID and has already stopped. Houses that, a perfect example is my primary residence. I sold my primary residence in 2022 for like $500,000. In 2020, it was probably like right before COVID, like late 19, early 2020, it was probably worth $400,000.
Yeah.
So it went up 20% or 25% in 2 years. Insane, right? If you sold that house right now, you might sell it for $500,000. It didn't really go up that much since then. No, that's just a specific house. But if you pick any house in Chattanooga, if you really want to be honest about it, it's different with duplexes and investment properties because they didn't go up as much earlier and now they've gone up since. But what actually happened was houses went up faster than the rate of inflation, but then we had a whole bunch of inflation. And one way to regress to that inflationary mean is for houses to crash. The other way is for inflation to go up. Because either way, you're starting to be back towards that long-term inflation trend line. And I think what's happened with most single-family houses and most non-investment properties in Chattanooga is that inflation's caught up with them, and so they're priced appropriately. It's the stagnation is coming from the interest rates, not from them being overpriced. No, I could be wrong, but I think what happened with the duplexes, why they went up so much in the last few years, is they didn't go up like that before, and inflation went up, and they had to catch up to inflation the other way, like a reverse crash, right? Like they were playing catch up. So I'm not entirely convinced the market's topped. I think we might stay at this level for another year or two, and then we might see growth again. So I'm not afraid to buy now either. Like if something works right now,
you'll buy it.
It's fine. Yeah. If it cash flows and I can get long-term debt and I have adequate cash reserves, I can buy it and I can keep it. And so if someone wants to sell their duplexes, I'll do the math on it and I'll see if it makes sense to me. That I sold some duplexes because my option was either to refinance or sell, and I wanted to get my capital out. But that doesn't mean I'm not going to buy a different duplex. With a different, capital stack, I don't have to use my credit cards to buy it. I can use a bank to buy it, right? And it turns out when you get rid of a bunch of credit card debt, now it's easier to borrow at a bank or whatever. So I could go borrow at a better rate effectively than I could have before.
Good.
So it's always about it's just always about like being strategic about how you're using your capital and especially with debt capital. Making sure that you're getting positive, not negative leverage. That's a concept that every investor, and really honestly every non-investor should know, but for sure investors. And what it means is when you have positive leverage, you're borrowing at a rate below your return on the asset. So the example of you buy a $250,000 duplex for cash, and let's say it makes $25,000 a year, just to make the math really easy after all expenses. That $25,000 a year is a 10% return. So in that scenario, it would be a 10 cap rate. That's the official technical term for it. Well, if you have a 10% cap rate and you can borrow at 7%, every dollar you borrow increases your return on equity. On the other hand, if you have a 5% cap rate, so that same duplex for $250,000 in cash, but instead of making $25,000 a year, now it makes $12,500 a year. So it's a 5% return on capital. Fine, it still can work. But if you have a 5% cap rate and you borrow at 7%, every dollar you borrow lowers your total return on equity. So that's called negative leverage, and it's fine if you buy a. Let's just do some really simple math. Let's say you have $150,000 in the bank and you don't know what to do with it, and you go buy a $250,000 duplex. You borrow at $100,000 to buy it, and at 7%, so you're paying $7,000 a year in interest, but you're getting $12,500 a year in after-tax profits. So you would take that $7,000 off the $12,500, and you'd have $5,500 left over. Not an amazing return on $150,000. It's like a 3% return, cash on cash. But that's fine if you're in a situation where you're like, I want something easy and predictable, but you can't borrow $200,000 on that duplex, because if you do, you're going to have $14,000 a year in interest cost, and you're only going to have $12,000 coming in after your other expenses, and you're losing money every month. So that's why it's really hard to buy in a high interest rate environment, because unless you get a really, really good return or a really, really good deal or put a lot of cash down, you're borrowing at a negative return. And
that's a great point.
So the negative return is really that's the main determiner of whether I'm going to buy something or not. Like if I can borrow at less than the return. And of course, you have to also keep in mind there's a risk premium on your returns. So like it's easy to say, oh, I get 10% on my money. If I pay cash for this, I'm going to make $25,000 a year. But what if my roof needs to be replaced that year and it costs me $10,000? Well, I didn't get $25,000. Yeah,
exactly.
So there is a risk premium that you have to consider. So you wouldn't want to borrow at like 7% and invest at 7.05%. You know, you have to have enough margin to make up the risk, right? And you have to consider that risk. But over the long term, if you can borrow at less than your long-term returns, then you always come out ahead.
Yeah, and I think that makes sense also as to why like it's more challenging for investors to find good deals right now, because you've got high prices and high interest rates, and just overall, I mean, obviously the return in every direction goes down when you have that to deal with. So,
well, I mean, anytime you have higher interest, your return goes down. Anytime you have higher prices, your return goes down.
And we got both.
Yeah, the only thing that you can consider is like, does the income go up to match it? And if it's really inflation, then the answer should be yes, right? Like if we have 10% annual inflation across to everything, it's irrelevant because wages went up 10%, rents went up 10%, costs went up 10%, everything went up 10%. It's irrelevant. The value of the property went up 10%. Actually, an inflationary environment is very good for a real estate investor if you're borrowing at a positive cash return, right?
Okay.
Like because if I borrow $250,000 and buy a $250,000 duplex and inflation hits and that $250,000 duplex goes up to $500,000, I still only owe $250,000. Right.
Sure. Yeah.
And so I just got $250,000 for free.
Yeah.
If there's 100% inflation tomorrow, I'm going to be jumping up and down for joy because all my properties are going to double in value and I'm going to owe the same amount of money and then I'm going to be really, really rich and it'll be awesome. Now, that would be really bad for some people because they don't have property and they might not get 100% increase in their wages. But if there was like a magic wand where everything just, you know, everything, it would just be a great transfer of wealth to borrowers in that scenario. If you could magic wand and make everything double in price tomorrow.
That'd be great.
It would be really bad for banks though.
Yeah. Because you owe less.
Because the borrowing, well, you owe the same amount, but the borrowing,
to what the value is.
Yeah, the buying power of the debt that they hold would be cut in half in that scenario because now $250,000 can only buy half of that duplex instead of the whole duplex. And they build that into their models. That's why they have margins and stuff. And the idea that 100% inflation is going to occur in one day is very unlikely. So banks don't worry about that particular thing. But that is kind of how it plays out.
Now you mentioned you talked about the income matching the inflation. So let's talk a little bit about just the like rental rates in Chattanooga. And like for me, I've noticed over the past 1 to maybe 2 years or 1.5 years or so, I've started to hear investors talk about getting less for their properties, or at least that their rents have kind of stagnated. And I've been in real estate since 2010, and consistently rents have gone up in Chattanooga until the past 1 to 2 years. So what have you noticed in that area?
I mean, the same thing applies to that regression to the inflationary mean, though. Rents should, over the long time, go up at the same rate as inflation. Yeah. But they don't always mirror inflation. They go up like slower than inflation when inflation's high, and they go up faster than inflation when inflation's low. But over time, it averages out. So inflation went up, rents went up. Rents went up before the inflation went up. They got ahead of that inflationary mean. And so like the houses, I don't think that rents are going to crash. But I think we might see stagnation for another year or two. Okay. But it could turn around really fast if inflation spikes, which we are seeing an inflation spike right now. So rents could start going up again. But there's also a supply and demand element to rent. Because when you're talking about a local market, national inflation isn't the issue. It's local inflation that matters, right? People are in California. It doesn't matter how much money they have. They're not renting an apartment in downtown Chattanooga, right? Unless they want to move to Chattanooga. Like there's a stickiness to this, right? So if we have a lot of inflation nationally, but prices in Chattanooga don't go up as fast, the supply might not change as fast as what people would intuitively think. But what will happen over the long term is some people will be looking at, I want to move, and they'll say, do I want to move to Birmingham or Chattanooga? And they'll look at it and be, oh, Chattanooga's cheaper. I'm going to move there. That will cause Chattanooga to eventually catch up to that inflationary mean. But the thing about inflationary means is that it's a long-term process and you can easily overshoot it in one direction or the other. And that may be occurring in Chattanooga now. And the reason I say that is we have a lot of unsold condo inventory and a lot of new construction that didn't get sold.
Has popped up too. Yes.
And you know, we're seeing that. So like, you know, we personally have some apartment buildings in Red Bank and Hickson, Chattanooga submarkets, if you're not familiar with them. They're doing okay, but we're offering incentives and, lower deposits to get people in. Yeah. And we haven't been raising the rents. In fact, one of our properties, we were renting for $1,200 a couple of years ago, and now we're renting for $1,100 or $1,050.
Still a little bit less.
Yeah, so
much,
just a little bit less. But when it's multifamily,
adds up. Yeah, that's true.
Let's say you have 20 units, and now you're $150 a unit less. Well, it's $3,000 a month less cash flow.
Yeah, definitely.
Which on a couple $1 million asset can be a significant percentage of the total cash flow. Because, the cash flow per unit on a successful multifamily might only be like $200 a unit. So if you lose 150 of it, you've lost 3/4 of your cash flow.
Yeah, that's an interesting point. Yeah, it's definitely something to
consider.
So
rents actually really matter. Now, in that particular case, we bought that property when it had really low rents, and so it's not as big of a problem, but we have refinanced it, so it means we don't have a lot of cash flow.
So you adjusted basically for the situation.
Yeah, exactly. But I mean, we do see that, and but it does seem to be getting a little bit better, actually. Now, I don't know that that's a long-term trend. It could be cyclical, but the last quarter, we've started to fill up those vacancies. Good. And we've started to see the softening of rent lessening. It's people are not giving as much trouble to get the same units rented. Okay. And in fact, in that one case, we had all of last year, and we have a 20 unit building in Red Bank that we had 4 or 5 units vacant almost the whole year, which is 25% of the building, and now we have 1 unit vacant. And we're getting the same rents we were last year. We're not getting what we were 2 years ago, but we're getting the same rents as last year. Yeah. So that's an improvement.
So maybe that's starting to stabilize a bit. And I would also say that just like the migration pattern here, I mean, that has slowed down like for a while, like during the COVID bubble. Sure. Like we were seeing about 300 people move here for every 100 that moved out. So now I don't know the exact ratio now, but that has evened out more. So there's less people that have moved here over the past couple of years or so versus just from 2020 to about 2023 or 4.
And there's 2 stats that matter in housing, and that one is the inbound migration, which is what you're talking about, and the other one is like general population growth, which it's like how many new babies were born in Chattanooga, but not how many new babies were born in Chattanooga yesterday. It's how many new babies were born in Chattanooga like 18 years ago, because those are the ones that are starting to rent apartments and whatever, and those trends are really positive. Population growth in Chattanooga has been very steady for a long time. And so we have like a whole generation of additional demand that's going to come online. Now, some of those people will take jobs in New York City or go to school in, California or something and won't ever come back. But a significant proportion of people that are born in Chattanooga will be in Chattanooga when they're an adult working. And so the younger generation is still pretty robust in Chattanooga, which means we can see continued growth, even if we don't have as much net inbound migration in the rental market.
Okay.
And then eventually in the homeowner market as well, because people typically, the normal pattern is you rent for a while and then you buy a house. Not everyone, not every generation, but in general, that's the normal pattern. So we should see, long-term positives in Chattanooga. Plus, I think, post-COVID, work from home stuff means that people have a little bit more flexibility about where they live and work. I know people that used to live in Memphis that live in Chattanooga now, and they work the same job that they had before. That helps a place like Chattanooga. Relatively low crime, beautiful, decent weather, nice people, and cheaper living makes people want to come to Chattanooga. So if you live in Boise, Idaho, you might be like, I love Boise, Idaho, I'm not leaving. But if you live in, I don't know, LA or something, you still want to come to Chattanooga. And yeah, it might slow for a while, but over the long term, I think the trends are still really positive for net inbound immigration to Chattanooga. Yeah,
and it seems like overall your outlook for Chattanooga is positive, even though there's been like some bumps in the road recently. Yeah. You still feel good about just your investments here because you've been doing it for a long time.
Yeah, right? I mean, I'm still we have lower vacancy in our commercial space now than we've had ever, almost. Office buildings are full, retail shopping centers are full. It's the apartments that are struggling, which is ironic because throughout the last decade, it's been the apartments that made the most money. Now, I will be honest, some of our apartments are doing really well and some are doing less well. Yeah. None of them are desperate. But I do know people that had bought 3 or 4 years ago that are in very desperate situations. They're doing, workouts with banks. They're losing their properties. Some of them are in Chattanooga, but a lot of them are national people that bought, hundreds and thousands of units. The multifamily recession is real.
Yeah.
From 2021 until 2026, multifamily, especially Class A and larger Class B multifamily, is down like 30%. If you bought a $10 million property with 20% or 25% down in 2021, it's worth $7 million today, and you borrowed 7.5 on it. And you probably, if you're like most of those guys, had 18 months of interest only, so you barely paid anything off. So you might owe $7.3 million, and you probably have variable rate debt, which means you can't afford to not refinance or sell, but you also can't afford to refinance or sell, because if you go to the bank and try to refinance and go, hey, I have an asset worth $7 million, I owe $7.2 million, they're like, cool. We'll be happy to refinance, but you're going to have to bring $1.7 million to the table. And it's called a cash-in refinance. And I know some major operators that did have to do cash-in refinances to keep their assets in the last year or two. I also know some that tried to do cash-in refinances, couldn't come up with the cash, and had to give the asset back to the bank or sell at a loss.
So what do you think is causing all that with the multifamily?
I mean, the same factors that, we were identifying on why rents are stagnating. What happened is inflation hit, which caused costs to go up. It was rather sudden because of COVID. And so people budgeted, $10,000 a unit to renovate, and they thought they were being conservative, and it came out $15,000 a unit. So they have 100 units, and they need to renovate 100 units, and they only have enough money to renovate 75 units. So now they're sitting at 80% occupancy because they have 20 unrenovated units that they can't get, or they're at less rent in the unrenovated units, whatever it might be, but they have less cash coming in, which causes their net operating income to go down. At the same time that happened, their costs went up on utilities and insurance, so that causes their net operating income to go down. They have less cash flow, even less cash flow. And then they get hit with a rate adjustment because they got through their 18 months or 3 years, and now commercial loans often have adjustments in them. And they bought a rate cap thinking they would be conservative, but now they're at their rate cap and they're paying 8% on their money, and they owe more than the property's worth, and their cash flow is lower than they originally projected because they never got their renovations done, and their costs went up.
Okay, so all the
and
inflation,
then rents didn't go up as fast as all that stuff happened, and so they got crushed. And it could happen to anybody. I mean, we had this happen to us. We didn't lose the property, thank goodness, but we have a 56 unit in Alabama. And we bought it in 2022, I think, or maybe 2021, but around there, same time period. And we got a really good deal on it, which saved our butts, honestly. But we budgeted around $500,000 to renovate it because we knew it needed to be fully renovated. We missed a few things in our due diligence that meant that we should have budgeted like $600,000, but we weren't off that much, and that would have been resolvable from cash flow and extra reserves that we had, because we had some extra reserves. But then inflation hit, and that $600,000 real budget turned into $900,000. So now we have $300,000 less than we need, and we were already off by $100,000, so we're $400,000 behind. So we're fortunately, because we got a good deal, we're able to go get a credit line and get $350,000 on a credit line, right? Which allowed us to renovate a lot of it, but even that wasn't enough. So then we're personally coming out of pocket to like loan the company money to get the renovations done. Now it's doing really well now, but that's because we solved the money issue. If we didn't have the extra $500,000 that we put in, we would be in the same situation as these other people. And the good news is it was 56 units, so it was $500,000, right? If it had been 156 units, it would have been $1.5 million. If it had been 250 units, it would have been $2.5 million.
I guess people don't know just until they kind of get into it sometimes how that stuff will add up, because we've had such a increase in the cost of construction and labor, materials, and all that. And when we're talking about inflation, just to clarify, you're talking about in this situation inflation on the cost of doing construction, basically, and then and you couple that with the decrease or flatlining in the rent prices. And so when all that happens, it's essentially causing the property to be worth less when that happens.
Because the standard valuation metric for multifamily is a cap rate valuation, which is like an income-based valuation. the higher your return, the more valuable the property is, essentially. You basically take a market cap rate and you apply it to the net operating income. It's just a math formula.
Right.
Like if your net operating income goes up, which is something you can control to some degree, then your property becomes more valuable.
Right.
And, listen, if you bought something in 2014, 2015, 2016, 2017, and the rents went up, you acted like a freaking genius. I bought a 12 unit in Ringgold for $600,000 in 2016. We raised the rents from $600 to $1,200 while I owned it. I owned it for 3 years and sold it for $1.25 million.
Yeah, it's a great deal.
Right. Made $600,000 on $130,000 down.
Yeah.
Right. Because the net operating income went up, and at the same time, interest rates went down and cap rates went down, which further supported the value. I'm happy I sold it. It's probably worth less now than it was when I sold it. And I 1031'd it into a retail shopping center, which is still doing really well. So it was like good luck on that part. But at the same time, there's other properties that we have, like the one in Red Bank that I was telling you about, 20 unit. We bought that in 2020, so a little bit before the run up, so that helped. But we didn't get it fully renovated before inflation hit because it was in pretty rough shape, and we had to do some capital calls and get some money into the property. Now we eventually did get it stabilized, refinanced, paid back our investors a huge chunk of their money, and they're still getting cash flow from it, so it's fine. But again, timing really matters. If we had bought that a year and a half later, it would not have worked out that well, and that's a little bit of fortuitous luck on our part.
I was about to say, just kind of getting lucky in some of those situations.
Yeah, but some of it's also reading the tea leaves. Like in 2020, if people want to Google it, they could probably find it. Because I was going on podcasts telling people, borrow as much money as you can. This is ridiculous. Inflation is 9%, and they're loaning us money at 3%. This is like extreme positive leverage. What I was explaining positive leverage before, if you can invest at a rate that returns more than the borrowing rate, you should borrow as much as you can, right? Well, in 2021, when interest rates were still 3.5% and inflation was 8 or 9%, you could literally borrow $1 million, buy $1 million worth of something like toilet paper, wait a year and sell the toilet paper and pay off the debt and have money left over.
Yeah, definitely.
Like because inflation was so high relative to the borrowing rate, they were actually paying you to take money. So you should borrow as much as you can in that situation. Yeah. That's not the situation we're in now. But if inflation goes up again and rates stay low, which is possible, if inflation hits 8% tomorrow and rates are 6%, same rules apply. Go borrow a bunch of money. Right now, I think inflation's 4% and we're borrowing at 7%. So, you don't borrow for inflation. You got to borrow for something that does better than inflation or not borrow at all.
Good deal. So I want to just talk about, before we wrap up, I want to talk about just the market cycle. And you've had you've talked several times on other podcasts about the 18-year market cycle and how that relates to rent prices and just how that works. So tell us a little bit about that and where you think we are right now.
Yeah, that's a hard one. So, the super short version is the 18-year market cycle is pretty accurate in as much as all but 2 cycles up until COVID were 18 years, or 17 years. The exception was right after World War II. There was a 36-year cycle where they basically skipped a full cycle. And that was a huge amount of growth for a long, long period of time. But historically, these things have been very similar. Yeah. COVID has kind of messed with that. So when I was talking about it before, it was really regular. But COVID caused a lot of inflation, which shocked the system and kind of elongated the current market cycle, if we want to be honest. Because if we were in an 18-year market cycle right now, it would be done. We'd be coming out of a recession right now. Yeah. We wouldn't be possibly going into a recession, which is what people seem to think we're doing right now.
So it's maybe 2 or 3 years off. Yeah. Maybe something like that.
I actually think we may have done like a World War II style skip of a cycle, and we might have no recession. That's essentially why everyone thought, this is why the baby boomers retired so rich. They didn't have a recession when they were in their most productive years. Every other generation has always had a recession in their most productive years. And I think we might be in a situation where the millennials get that luck also, because we have anti-recessionary trends in place with AI and huge amounts of operational efficiencies coming. And, in general, the economy is a product of the total man hours that go into producing labor and the productivity of those man hours. And man hours are going down right now. Like person hours are like people are working less.
Yeah.
People are unemployed. Immigration slowed because of current government policies, but at the same time, productivity is going up insanely fast. So we could be in a situation where productivity gains so greatly outstrip the reduction in man hours put in that that we have 1,000% higher economy in 5 years. We could have 100% annual growth 2 years from now. That is I know that sounds wild, but it's not inconceivable when you consider 27% of the U.S. population is directly related to transportation. It might be slightly different now, but when I was in transportation, that's the number we were always hearing. It could be 25 or 30, but I mean, it's a huge chunk of the total employed population works either as a dispatcher, a truck driver, someone who loads and unloads trucks. Well, all of those jobs are going to be automated away. We know that for sure. Self-driving taxis already exist, right? I've ridden in them, and they're going to keep coming, and they're safer than people driving. Well, that brings the labor cost of transport way down. We were talking before about how energy prices dramatically increase inflation. Well, labor also dramatically increases inflation. If wages go up, inflation goes up because it's a productivity element. But if we no longer have wages in a sector of the economy, that is deflationary. That lowers prices, right? So we could be in a situation where all of the money that the government is printing and all of the waste and all of the blowing things up for no reason, all of this stuff, right? All of it may be completely offset by productivity gains. And we might be in a situation where things become essentially almost free and no one really cares about money. That's the optimistic scenario. There's a lot of less optimistic versions. But the point is we don't really know what's going to happen. So when we look at the market cycle, there's a different way to look at it than just the 18-year cycle. There's a long understood market trend that involves historical occupancy rates. So basically, if you could form a XY axis with the horizontal line being the long-term average occupancy in a market. So we just take duplexes in Chattanooga. Let's pretend that the average occupancy rate of duplexes in Chattanooga is 95%. Right? So if that horizontal line is 95%, and if occupancy is at 97%, you're above that line. If it's at 93, you're below the line. Those become an important data point. And then the other line is occupancy going up or down, and by how much? Okay, so you have long-term historical occupancy and the trend. If you look at those two lines and occupancy is going up, then it's going to be to the left of the vertical line. And if it's above 95%, it's going to be to the above the horizontal line. Well, then we know it's in that upper left-hand quadrant. Yeah. And if it's in the upper left-hand quadrant, we know occupancy is high and it's still going up, right? The next quadrant over, occupancy is high, but it's going down. Then below that, you have occupancy's low and it's going down. That's a recession. That's when we're in a nasty spot. Yeah. And then you have occupancy's low. It's below long-term historical averages, but it's going up, right? And that's called recovery. That's what happens at the end of a recession and the beginning of growth, right? But as long as occupancy is below the long-term historical occupancy line, rent continues to fall because people say, geez, I got to get my occupancy up. I better give incentives. I better lower my rent, right? And that's what was happening to us in Chattanooga. Like in Red Bank, our particular property was below our long-term historical occupancy. Therefore, we had to offer incentives to raise occupancy, right? Now, it's going up now. So if we were using that little property as an example of the whole market, we could say we were in a recession for the property. Now we're in recovery. Occupancy is still a little bit below our long-term historical average, but it's trending in the right direction, which means next we should see occupancy getting above the long-term historical average. And we might be there now. At that point, you start raising rents. Because if you modeled on 5% vacancy and you're at 99%, you're like, oh, I can raise my rent. Because if I have 98%, it's probably fine if I'm getting more rent, right? So what happens is everyone that owns a property is going through this, even though they're not thinking about it that way. When occupancy is low, they're like, oh, I got to do something to get occupancy up. And when occupancy is high, they're like, well, I can try raising rents. right? And so like every single individual investor is doing that in the micro environment. So the macro economy, if we can look at those long-term historical trends, where's average occupancy for duplexes in Chattanooga and where's occupancy now and which direction is it going? In other words, where was it last quarter? Where was it the quarter before? And look at that trend line. We can predict where we are in the market cycle exactly. That data is available.
Yeah.
It's available nationally all the time. You can buy it. It's available for the major MSAs, like, Atlanta, New York, Chicago. These are really easy to get the data. A place like Chattanooga is a little bit harder, but we can still get it from like property managers and things like that and real estate agents. And what I feel is, granted, unscientific survey, we have a couple hundred units in Chattanooga in residential apartments that, I have some influence over and see the data on. And then my partner's property management company manages more than that. And as a result of this, it feels to me like we're actually in a recovery, which is why I think it's really interesting that everyone thinks that that the market is toppy and like it feels toppy like when I just look at prices. But when I look at, and again, this is multifamily, it's not single family. So like single family could be, in a completely different spot and occupancy could be falling in single family. And that may be the case. I don't know, right? I don't do as much in that part of the market, but at least for multifamily, it feels like we're coming out of a recession, not going into a recession because occupancy's going up. Occupancy is still relatively low, but it's getting closer to that trend line. And where all the money is made is the expansionary phase, which comes immediately after recovery. So it's literally like recession, recovery, expansion, and then what's called hypersupply. Hypersupply is the dangerous point where everyone's happy. That's 2021, right? For multifamily, everyone's happy. Everyone thinks everything's going well. But meanwhile, supply isn't lined up correctly and there's more supply coming on the market than being absorbed. And so as a result of that, occupancy rates are starting to fall, but people don't notice yet because they're still high. It's only when they get low, they're like, whoa, we got to do something about it, right? Because if you have 1,000 units and you have 995 of them rented every month and you go to 993 rented, you're like, whatever, because like you always figured you'd have 100 units out of the 1,000 that weren't rented or 50 that weren't rented. So then you go to 975 and you're like, you don't even notice it because in your mind, you're like, our occupancy is 97.5%. That's great. But then one day you wake up and you're like, whoa, I only have 940 units occupied and I have 60 unoccupied units. And you're like, this is scary. I got to do something about this. This is starting to affect my bottom line. And so for multifamily, I feel really comfortable. I actually kind of feel the same for rental properties in general, because I think rents are there. And rental properties, of course, support the single family market because, if the single family market starts to tank, then people have this alternative where they go, well, I could just rent my house out. You know what I mean?
Yeah, exactly.
And that's what you'll start to see people doing if the rental investor market is still good. Because then even if the person doesn't want to rent their house out, Joe homeowner has a house and he's owned it for 20 years and he doesn't want to be a landlord. He doesn't want to deal with fixing toilets, but he's ready to move and retire to Florida. He puts his house on the market. If there's no buyers, he has to lower his price. But at some point, the investors look at it and go, oh, I can rent this and make money. And when you hit that level, that becomes the floor for the individual buyers. Because now Sally home buyer isn't going to like buy the house, but whatever the investor's name, I'm going to stop making up random names. Like William investor is going to buy it, right? So like whenever that occurs, William, that was a terrible choice. We should have picked Eddie investor. That would have been more fun.
That'd be a good one, the best one.
Yeah. But anyway, the point is at some point I decide to buy single family houses again. I haven't in a long time. We sold them to homeowners, frankly. We owned a lot of single families up in Michigan and we sold most of them to homeowners over the years because homeowners are willing to pay more than what we could get.
Oh, definitely.
Good return. But the investing return becomes the floor. It doesn't go below that. If there's an investment return to be had, the investors will scoop up those properties when they get to that level. And so that's why I don't worry about them long term because inflation is going to continue. or we're going to be in that radical anti-inflationary environment from AI, and then none of it matters, and we can't do anything about it, right? Where everyone just gets everything for free, I guess, because there's no money left. No one has jobs.
Scenario, yeah.
But assuming that like doomsday scenario doesn't occur, or utopian scenario, depending on how you look at it, assuming that doesn't occur, if stuff works, it works. If it doesn't, it doesn't. Just buy the stuff that works if you're an investor. And if you're trying to sell, just look at that. What's my return on equity, and can I reinvest somewhere else better?
Exactly. Yeah, I definitely think you've given us some great information on what to do if you want to sell your rental properties right now, and even if you want to hang on to them or refinance. We've talked about all that, so I definitely appreciate your input. We'll definitely talk about it again soon. So appreciate it, Jeff.
Thanks for having me on.
Yeah, we'll talk again soon. Thanks.